Welcome to HSBC Global Viewpoint, the podcast series that brings together business leaders and industry experts to explore the latest global insights, trends, and opportunities. Make sure you're subscribed to stay up to date with new episodes. Thanks for listening, and now on to today's show.
This podcast was recorded for publication on the 19th of July 2024 by HSBC Global Research. All the disclosures and disclaimers associated with it must be viewed on the link attached to your media player. And don't forget, you can follow us wherever you get your podcasts. Just search for the Macro Brief.
Hello, I'm Piers Butler and welcome to the Macro Brief. As the benchmark for the government bond market, US Treasuries are closely watched by investors and the media alike. But what are the most important factors influencing Treasuries? A lot of comment focuses on short-term factors such as data releases. But should we all be paying closer attention to longer-term drivers such as demographics? Steve Major, our Global Head of Fixed Income Research, joins us from Dubai to discuss the things about bonds. Steve, welcome to the podcast.
Thanks for having me, Piers.
Firstly, Steve, I just wanted to talk about your regular publication, the appropriately called Major Bond Letter, which actually listeners can get hold of by following you on LinkedIn, and which broadly aims to demystify the sometimes complex topic of bonds?
Yeah, I think that's a good description, Piers. It's one of those where it's 2 pages long, so it's not as deep as some of our thematics or some of our asset allocation pieces, but it's targeted really at an audience who wants to get access to the important things about bonds. And for me, there's sometimes too much complexity. And I think that we as analysts might be guilty of adding to that, to tell you the truth. But I'm just trying to get to what matters, what the key themes are, what's driving bonds. And sometimes it's actually more challenging for me to write just 2 pages than 20, but there you go.
That's often the case. And in fact, in your latest one, you highlight this current divergence between short-term US Treasury rates and the long-run equilibrium. So what do you mean by the long-run equilibrium, and why the divergence?
Sometimes in markets, it's called the R star, and it's the real natural rate. This is some point in the future, which could be at least 5 years or so, whereby the economy has full employment and inflation is at the target. So it's a completely theoretical concept, but it's useful for central bankers and analysts to have some kind of anchor like this, because when the policy rate is higher, then it's restrictive. When it's higher than this equilibrium, it's restrictive. When it's lower, as it has been, then it's accommodating. This neutral rate moves through time, but very slowly, because there are secular forces that explain why it moves, which is very different to what many people in the market are focusing on every day, which, by the way, is not wrong. It's the data, it's the incoming data, but the incoming data is really about cycles, near-term cycles that are moving within very short-term periods. So it's necessary to have both an eye on the near-term cyclical drivers and the policy rate, and then the longer-run equilibrium.
But is the point that you're making that, looking at the extent of that divergence, that perhaps the market is too focused on the short term and should be maybe paying a little bit more attention to some of these longer-running secular trends?
Yeah, and I think it's also a response to the feedback I get in client meetings, because when the majority of the questioning is on the next CPI or payrolls release or next move from the central bank, it tells you what people are thinking. But for me, if you want to value a 10-year security, you need to think about discount rates over the next decade, because that's how you value a bond. A bit like for the equity market, you need to have an eye on what the long run rates are to input into your models. Well, it's the same with a bond. You cannot value a 10-year security with the policy rate. You need to know where it's going. So having a view of the equilibrium is something that we are all doing, whether we know it or not. So it's conscious or subconscious. Every investor and analyst is taking a view on the longer run equilibrium when they're talking about 10-year yields.
Now, you and your team published a report looking at some of these longer run secular drivers. In it, you say that demographics is the most important secular driver of bond markets. Can you explain to us why that is?
Yes, so the Bank of England claimed it was the biggest factor in a recent report. Also, when people talk about the various determinants of longer run equilibrium, demographics is top of the list. And I think that there are many reasons for this. And it's to do with the life cycle hypothesis and the idea that people save whilst they're working and then they start to deaccumulate in retirement, that kind of thing. And therefore, some people are taking a view based on that something is changing as the population ages and dependency ratios shift. Dependency ratios are the proportion of people who are not working, so they're retired or too young, divided by the people that are of working age. So that is a key theme that HSBC has looked at. But for me, the demographics and bonds requires a lot of thought because there are many moving parts. One, it's global, and two, we've got to bring in all different areas of behavior, and that involves credit formation, deleveraging, people wanting to bequest, what's happening to our longevity, how people in retirement start to hedge the tail risk that they might live longer than they thought. So there's all kinds of factors, Piers.
And Steve, you make another bold claim, and that is that credit creation matters and that academic literature often overlooks this. Yeah.
So it seems that many people in the market have an opinion that things might have changed. And some of the academic work was released before the pandemic. And the idea was that populations are aging, they'll be dissaving, and with aging populations, higher dependency ratio, wages could go up because there's a lack of people to look after the old people. And it seems like that view might have been right for the wrong reason, because inflation went up very quickly due to the supply chain shocks during the pandemic. We've taken it apart and looked at all the various factors here. Now, credit creation is one of the interesting ones because boomers, these are the baby boomers from after the Second World War. They would have taken on mortgages, which gave them leverage to accumulate assets, and they're not going to be doing that in retirement. So you get some of the opposite effect. So it could be that there is a distortion in the data because of the surge in previous credit creation. The other thing about this, which is very global, is that if we look at individual countries, we're missing migration of people from one country to another, and we're missing the movement of capital from one place to another. So imagine that there is a part of the world that needs to save because it's got a young population. I'm thinking here about the GCC region, and you could say India and parts of Africa. Those young people need to save, and they need to find assets to save in. Now, it could well be, for example, that they choose dollars for lack of alternative products locally. So you have migration of money and migration of people. And one of the best examples that we point out is the UK Health Service. You can see the nature of the people working in the health service, a big shift towards Southeast Asia, whilst EU employees of origin from the EU declining. Similar things happening in the US thanks to migration. That has actually put a cap on wages when many were thinking that wages would surge because there'd be a lack of people. So the simple response is it's dynamic, Piers. Money and people flow to the places where there's value and demand.
One of the big disinflationary forces of the global economy in the last 3 decades, as you point out, has been China and its entry into the global markets. So as that economy matures, does that disinflationary force disappear, or is it being replaced by something else?
Yeah, it would be reasonable to say on a static analysis that China has matured and evolved such that it's not contributing the cheap goods that it was in the past. So therefore, as a disinflationary force, it's much less today than it was 10 and 20 odd years ago when it joined the WTO. Can't really argue with that because China is going up the value chain. The cheap products that it exported were possible because of huge amounts of people moving from farms, from rural communities to urban communities. That's the theory that China would stop exporting disinflation. But here we are post-pandemic, and it actually doesn't seem to have happened, by the way. But our point was that there are many other countries that are doing the same thing. And you can think about India, Mexico, and Vietnam. There are three of the countries we mentioned. So you need the right combination of young population moving from the rural areas to cities, wanting to do these jobs. And you have to have the right combination of governance as well. But our point is, there are many billions of people waiting to fill the shoes of the Chinese population that was doing this in the past. So it's evidence-based as well, Piers. It doesn't seem, one, that China has stopped exporting disinflation, but also the evidence is that manufacturing is moving to other places where it's cheap.
And what about Japan? Obviously, there's a lot of deflation in Japan. What lessons can we learn from looking at that market?
It's not so long ago that we were writing about the Japanification. Jamie Stoddard, my colleague, tells me that people were talking about Japanification of the West a long time ago, maybe as long as 15 years ago, but we wrote about it in 2018, 2019, at a time when German government bond yields went underneath the Japanese equivalents. Now, of course, they're not there now, but Japanification of the Eurozone was a big theme pre-pandemic. And Japan is a lesson, really. What happens after a boom turns to bust? And in Japan's case, it was due to property. It had a big impact on banks, big impact on confidence. And it's interesting how this could be playing out in other parts of the world today. In many ways, the excessive leverage of the past is, funny enough, linked to the demographics today. Because if confidence is lost, then young people don't go and buy houses, they end up staying at home, and actually it has an impact on the birth rate. So when we talk about Japanification and demographics, that's where I'm going. There's also the zombification of companies and corporates. We've seen that as well, whereby because of the low rates and keeping rates low for a very long time, you don't get the creative destruction that you would have in a normal rate cycle. So there's many lessons from Japan that have played out
that we should basically be paying attention to on a more global basis. I want to bring it back to the short term. Where do we stand on inflation? In one of your major bond letters, you talk about a narrative fallacy. What do you mean by that?
Well, I took that from the book by Nassim Taleb, so that's the Fraud by Randomness, and he refers to how it's been possible for the media to take an event and have on the same day two different views of that event, and we're seeing that sometimes around inflation. Some people think it's sticky, some think it's moving back to target. I think in addition to the fallacy effects, so different interpretation of the same news, you can also have a transition in the narrative. And what I think is going on at the moment is that we're gradually transitioning away from inflation, because inflation's been falling the last few months and moving back towards target, and more of a weight is going on to other things like the real GDP. Now, my point in all of this is that when you're looking at bonds, it's not just CPI and real GDP, it's also the longer run equilibrium. And central banks have to have one eye on financial stability as well, for example. So the idea of narrative fallacy is that just because everyone's talking about the same thing doesn't make it right.
Very true indeed, as I've experienced on many occasions in the markets. Can we finish on this point that you make, that on balance with bonds, you might be better off doing nothing? You do this exercise in one of the bond letters of shocking the yield curve and illustrating how, you would be better off basically waiting.
Yeah, so there are all kinds of different investors. Some are more dynamic than others, and you can think about the range of traders and hedge funds compared with pension funds and life insurance companies that just buy and hold. My point is that with the higher interest rates, we've seen the restoration of coupon to bonds across the curve. And in credit markets, in investment grade credit, you can get 100 basis points or more extra on top of the sovereign. So that means it's quite possible to sit with a yield to maturity of between 5 and 6%. And my argument is if nothing happens, that's not bad. You're going to be in a pretty strong position if you can hold those bonds. And if inflation indeed does stay where it is, you're going to have a positive real yield. But of course, my point was that if the yield was to go up 100 basis points, you would of course lose some capital, but you're compensated by the receipt of the coupon, which is at a much more decent level than it was only a few years ago. Now, of course, if yields fall a lot, then there's capital gain plus coupon. So it seems to me there is an asymmetric bias to the setup, and I'll just complement that point by saying that policy rates are most likely going to be unchanged or down in the coming months, because that's what central banks seem to be guiding. So for an investor, sitting in bonds and being patient seems to make sense given the asymmetry in the outlook.
Well, I hope that this has given the listeners a flavour of the major bond letters. As I said at the start, you can find them by following Steve on LinkedIn. And as we said, they really, I think, personally demystify the sometimes complex subject of bonds and give the big picture. So, Steve, thank you very much for sharing that with us.
Thank you, Piers.
So that wraps things up for today. Don't forget that if you have any questions on global research, email us at askresearch@hsbc.com. From all of us here, thanks for listening. We'll be back again next week.
Thank you for joining us at HSBC Global Viewpoint. We hope you enjoyed the discussion. Make sure you're subscribed to stay up to date with new episodes.